Are you managing for the coupon now? Is it just you've got your scissors out at JPMorgan and you and Mr. Diamond are just, clipping coupons?
There's a lot more to do in the bond market right now. And there's
Such as?
Well, we were talking about high yield earlier, and that's the question I get asked the most by our clients because suddenly the yield is through 6% and it doesn't seem like high yield. But credit spreads are 4.5% and default rates are 1%. So, yeah, I'd like to collect that 4.5%. How do I do that?
Well, when you do that, and Lisa, you've written about this many, many times, is high yield just another phrase for high risk?
Well, and one thing that I was going to ask Bob is, with the energy prices, the oil prices coming down so much, it's actually a fundamental threat to some of the oil companies that have been among the biggest borrowers among oil companies.
We learned this yesterday. They're a big part of the high yield market, right?
Oh, yeah.
17%, according to Tobias Levkovich.
Yeah, they've increased their proportion of debt in the total index dramatically, almost doubled the proportion in the past 7 years.
Do you worry about that, Bob?
We do, and I think that's the unanswered question about the markets today is what will be the impact of the energy companies? Because, again, historically, when you've had a decline in energy prices, it's boosted corporate earnings in the U.S. But now that energy is such a much larger part of corporate earnings because of the investment in energy companies, they're the ones that are going to get hurt. So it does concern me a bit. But I think overall corporate balance sheets outside of energy look very good. Default rates are still quite low. So I think it's pretty safe to still be in there.
Bob, I'm going to pile on to high yield because, you point out the default rates are low and you suggest it as a carry trade. How long do you carry that trade? How long do you stay that levered?
Until the Fed takes the punch bowl away. And when you look back at the history of when high yield tends to correct and go through convulsions, it's after the Fed has finished tightening monetary policy, because then they've burst whatever bubble has occurred, and then suddenly you get that deflationary spiral and high yield collapses. I think we're several years away from that.
In fact, you also say that we're about 60 to 65% of the way through the current credit cycle. I know that you see opportunities in Europe. If that's where we are in the U.S., where are we when it comes to Europe's credit cycle?
Not even near 60 to 65% of the way through. I think we're probably a third of the way through. I think the asset quality review was a credible test. I think the banks did well. It's not a surprise. They've been the focus for the last 5 years. We were talking about Spain earlier. 4 or 5 years ago, they were taking in deposits by posting 4 to 5% deposit rates. You couldn't invest that in the bond market. So they got a lot of capital. So I think there's some pretty good value in the European bond markets, and the punch bowl isn't going to leave Europe anytime soon.
Well, let's stick with Europe because I'm going to read back something from your research note from October 9th to you. We're looking at Eastern European countries that have solid current account balances, that have manufacturing-based economies, and that may benefit from the stimulus that's coming out of the ECB. Bob, don't be coy. What countries are we talking about?
Well, I think you could look at Hungary, you could look at Turkey. I think those are the types of countries that benefit in the current environment, and they're doing quite well.
One thing that I know that that regulators are increasingly concerned about is a potential mass exodus from bond funds. How concerned are you about something like this?
Well, as a career bond investor, I certainly don't like to see anybody leaving bond funds, but there's no doubt that the exit can be crowded, and certainly one of the unintended consequences of the new regulatory environment is decreased dealer balance sheets. So everyone's trying to think about where the new balance sheet to absorb outflows can be created.
I like that. But this is really critical now. And this dovetails the oil worries that, Lisa, you brought up with your idea of a crowded trade. Here's the Anadarko Petroleum bond. This is not the stock. It's the price of the bond. So you made a lot of total return here. You got the coupon, 6% along the way, plus capital gain from 80 to 100. And then, Bob, you get this. And your worry in your crowded market is all of a sudden higher yields, this rolls over. Is that a 2015 event, or is it farther out?
Well, it's not only my worry; it should be the Fed's worry, right?
And our viewers,
Yeah, and it's a lot of people's worry, and I go back to how the Fed manages a normalization in interest rates. If they do it prudently, and the forward markets have priced in pretty accurately how they're going to do it, I think you can have a pretty good bond market and not an immediate rush for the
So
exit.
you support Bill Dudley's informed complacency here versus what I hear from, say, Marty Fritzen, the acclaimed bond math guy, who's really worried about instabilities. Which can it be?
As with everything, it's not all one and not the other.
You can just answer that and say the San Francisco Giants. That's a safe answer.